This is the Asia Trade. I'm Paul Allen in Sydney.
And I'm Annabelle, Droulers in Hong Kong. The top stories this hour. Asian stocks look set to rebound even as President Trump reignites trade tensions with a threat to stop buying Chinese cooking oil. The dollar weakens as Fed Chair Jay Powell signals another rate cut and an imminent end to balance sheet reduction. JP Morgan chief Jamie Dimon sounding a warning on credit quality, overshadowing a solid start to US bank earnings on renewed deal-making and strong trading. And Japan's opposition parties intensify discussions on uniting against the ruling LDP leader, Sanae Takaichi. Well, Monday in the session, we were all about the taco trade. Tuesday was about renewed trade tensions, and certainly you saw that really being reflected on Wall Street overnight because we had President Trump, as I just said, saying he might stop trade on cooking oil imports from China. That was after China had sanctioned US units of a Korean shipping giant. But actually, as we approach the session today in Asia, you can see we're pointing to some upside momentum coming through. We're seeing equity futures, for instance, Tokyo, Hong Kong pointing to gains. You have the Sydney session coming online this morning, again, in the green so far. So it's sort of shrugging off that theme that we had developing on Wall Street overnight. Let's take a look actually about how the US benchmark closed, because we did see some declines into the end of the session here. Very sort of whipsaws trading, a lot of volatility as well coming through in the session. There were some brighter spots, and you can see that being reflected because we can see the banks index, for instance, up 1.8%. As we said, it was a pretty solid start to the earnings for banks. Lots of different bright spots. So unofficially kicking off the season for results across the board. We continue to keep a watch on the two-year yield. You can see they're just pulling back slightly, but you are around the lowest level since 2022 for that. And we did have those remarks from Jay Powell as well, Paul, that really reinforced bets we might see that rate cut coming in October.
Yeah, and you mentioned about the taco trade backing off on Tuesday. President Trump saying now that he might stop trade in cooking oil with China as retaliation against Beijing for its refusal to buy American soybeans, which he calls an economically hostile act. Now, in a post on social media, President Trump said the U.S. can produce its own cooking oil. Let's bring in Bloomberg senior editor now, Derek Wallbank. So, Derek, what's the most likely outcome of this latest escalation? Is it merely symbolic, or could it potentially go further, or are we looking at another taco moment?
Well, Paul, I think that, it's going to remain to be seen what the actual outcome is here. But what we're seeing right now is we're seeing a substantial escalation in this sort of like here and there tit for tat kind of go back and forth between China and the United States, both of them ratcheting up tensions in some small ways here and there, walking into what is going to be a showdown meeting between Trump and Xi expected at the APEC conference, or on the sidelines of the APEC conference in South Korea. Now, Donald Trump, in this case, particularly upset about China's lack of soybean purchases, pretty much cut off at this point. And look, to really kind of understand this, you have to understand the U.S. electoral map. Donald Trump, heavy support out of rural areas, heavy support from farmers particularly. But farmers are also a group as a whole that can be hurt by retaliation in a trade standoff between the U.S. and China. China putting pressure on soybean farmers is essentially a form of putting pressure on Trump allies. And look, Xi Jinping knows this very well. He has U.S. experience in his background, and some of his U.S. experience is related to Iowa, big agricultural production state. She knows exactly what's going on here and knows exactly where this pressure leverage is. Trump making it very clear he's willing to push back if necessary. The U.S. is a major export destination for cooking oil. Last year, something more than 40% of China's exports going to the United States, not an insignificant threat.
Yeah, it's interesting because just hours before Trump put that post out on socials, we had him and also the U.S. Trade Representative Jamison Greer expressing confidence that they would be able to make progress through talks.
Well, Bell, look, we've seen it before. We'll see it again. And Jameson Greer's telling us it's all right. And this is the bull case, I think you would say, walking into that showdown meeting between Trump and Xi. The idea that even if all of these things go on, you have the soybean stuff, you have the ship sanctions to the Korean units that are aiding the United States and Trump's push to increase manufacturing there. All of these things there. Jameson Greer presenting what I think is the Trump administration's overall case, and also right now the general market bet is that this is going to get better before it gets much worse. Might get a little worse before it gets better, but the general market bet is that it's going to get better before it gets a lot worse, if that makes sense. Because we're not really seeing a lot of positioning in the market expecting that Trump's threat, for example, of another 100% tariffs to go onto China to actually get through. Remember, the threats that we're talking about here that are put on right now, especially from the White House side outward, are close to the levels that we saw earlier this year when China and the U.S. both raced to pull back at levels that would have been seen as an effective decoupling. And we're pretty close in terms of the threat level of getting there, but you're not seeing a market reaction that is sort of congruent to that threat, which is a suggestion that there is a market belief that we're not going to actually get there.
Derek, we've also got the EU potentially placing some pressure on China as well, apparently considering forcing China to hand technology over to companies that want to operate in the European Union. What are the details on this, and have we had a reaction from China?
Yeah, it's a really interesting thing, Paul, and we'll sort of see where this one goes. But this is a move that sort of holds a mirror, if you will, to a Chinese policy. You could almost say that the European Union got the idea from China in some ways, but it's another step that we're seeing from some economies trying to figure out how to counterbalance Beijing and some of the industrial capabilities that Beijing is capable of. Europe has seen itself as a really lucrative market and a really powerful place if they all push together. You see this in a lot of ways across Asia, with companies having to feel like they have to meet European regulatory standards, whether or not they have huge operations there, just because that's sort of the price of doing business. This would be another indication if they were actually going to go through this. But we've seen a lot of moves from Europe where some of these things are proposed, but it doesn't necessarily come out as stiffly as they ultimately, as they initially suggested it might.
All right, Bloomberg senior editor Derek Wallbank there. All right, well, let's see how we're shaping up for market action this Wednesday in the Asia Pacific. And the resurgence of trade tensions dominated the narrative in the U.S. session with that risk-off mood following what appeared to be a potential escalation of trade tension, overshadowing earnings beats from big banks. Asia, though, possibly eyeing a rebound from the overnight sell-off. Let's get to MLive strategist Mark Cranfield joins us now. So, Mark, what sort of reaction might we anticipate when major Asian markets open today?
Yeah, I think we would get a small improvement in markets this morning. There were some pretty hefty sell-offs yesterday, particularly in the Hong Kong, China space, and some of that will probably ease a bit. So they'll certainly be soothed by what Jerome Powell had to say. But obviously this tit for tat that Derek was talking about earlier there between China and the US, that is going to override Asian markets for quite a while. Now, the problem is that APEC meeting is at least 2 weeks away, if it happens at all. There's no certainty that President Xi and President Trump will actually meet. So investors are going to be very nervous about whether it's on or off. And in the meantime, there's plenty of room for more of the tariffs on, tariffs off between the United States and China. So we are probably going to be going on a day-to-day basis here, where investors are going to be very edgy, looking for the next headline that drops either from the American side or from the Chinese side. That will really modify any chance for people to get very aggressive on the markets. It's unlikely we're going to see any strong upward moves in markets while people have this in the background. They're going to be nervous about it. We also have TSMC results out this week. We're expecting them out on Thursday. That will also give us a very good indicator of where people see the outlook for AI-related things. But it's going to be choppy, nervous trading, and it's unlikely that we're going to see sustained gains in markets in the near term.
Is that going to be offset at all, do you think, by these expectations we're going to get further Fed easing? Because we saw Jay Powell really reinforcing these bets overnight that we are going to see that cut coming in October. But just listen to what he had to say.
The labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So as they come more into balance, I think the idea has been that policy should move from being, tight to some degree to being more neutral as those two things balance out.
So as we heard from analysts, Mark, nothing's really changed the perspective that there's still downside risks to the labour market. How does this also factor into the equation for trading activity?
Well, particularly from Asia's point of view, this will be very reassuring to investors in Asia, because there are central banks across the region who wouldn't mind lowering interest rates a little bit further because they are uncertain about where global trade is going. So the fact that the Federal Reserve is still on this path, Jerome Powell is signaling that more rates are going to come on the downside. And in fact, the traders are pricing for up to 100 basis points worth of cuts by the middle of next year. So that's pretty significant. So it looks as though the Federal Reserve, the federal funds rate, is going to go down towards something like 3%, which is still quite away from where it is now. And that means that Asia can work from that. So central banks in Asia who are looking for windows to lower their own rates will certainly have opportunities in the months ahead. That will probably support Asian currencies as well. And that in turn is positive for the equity markets in Asia. So all of that is looking positive in the long term for Asia.
Mark, I also want to get to a question that's, the subject of much debate at the moment in terms of whether or not AI stocks are in a bubble. Bank of America's survey of fund managers says, yes, possibly they are by a narrow majority. So what does the survey say? What's the nuance here? And if it is a bubble, is it going to burst or just gently deflate?
I don't think there's many people who've been watching financial markets this year would question the idea that AI is likely, or AI-related stocks are likely to be in a bubble. I think the investment flows into that, the huge deals being done between people like OpenAI and NVIDIA and the other major companies, particularly in the United States. Even in China, you see lots of new AI products being produced by their own local companies there as well. I don't think, when you look at the way that markets have rallied, AI has outperformed so many other sectors, people would say, yes, most likely we've entered a bubble. The big problem, and unfortunately this survey doesn't help us, is that when will that bubble pop? Is it going to pop this week? Is it going to pop in 3 months, 6 months, a year's time? That's the tricky part. As Alan Greenspan once reminded us, you only know the bubbles, that you're in a bubble, after it's popped. And that's not really much help from an investment point of view. So people will stay with it for the time being. They'll look to earnings, but they will be cognizant of the fact they need to get out at very short notice.
Yeah, timing's really everything. That was our MLive strategist, Mark Cranfield, there. And as we were just discussing there, the bank earnings as well, sort of one of the brightest spots that we had in the Wall Street session overnight, Paul. I mean, it was also a lot of numbers. JP Morgan, Goldman Sachs, we had Citigroup and Wells Fargo as well. But just sort of in aggregate, it was pretty positive across the board. I mean, you had JP Morgan beating analyst estimates down to its trading, investment banking fees. So it's really benefiting from more underwriting, but also from more deal making. And that was very much the same story for Goldman Sachs on the deal making front in particular, because they actually notched their best third quarter on record. Citigroup as well, I mean, it exceeded revenue estimates across all 5 of its major business units. So it's a very strong vote of confidence for the CEO, Jane Fraser's turnaround plan. And then smaller peer, Wells Fargo, another winner because it did set out higher profitability goals as well. So you saw that real reaction in the bank stocks overnight, even as you had some warnings coming through from Jamie Dimon.
Yeah, let's talk a little bit about that warning because, of course, as you mentioned there, JP Morgan did beat its own guidance, but Jamie Dimon is sounding that warning about credit quality. And JP Morgan's had a brush with this as well with the Tricolor issue. That cost them $170 million when Tricolor collapsed. That's the auto dealer as well. And JP Morgan set aside another $810 million in reserves for potentially soured loans. So as the saying goes, there's never just one cockroach, and that's a theme Jamie Dimon leaned into. Let's have a listen to what he had to say.
You should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, we think we're okay and other stuff. But my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
And against the backdrop of that as well, you had also these question of how much AI is being implemented, what sort of cost savings are you seeing, but also what job losses are on the way. And this was also a feature of Goldman Sachs earnings because they said that essentially staffers should be expecting additional job losses this year across divisions. They're looking to take advantage essentially of the cost savings that are presented by AI. They're looking at a multi-year rollout of the technology as well, how they're going to be including it across various business divisions. But another interesting element out of the bank earnings so far.
Yeah, absolutely. It's still to come on the Asia trade. We're going to have an exclusive interview with Citi's chief global macro strategist as we unpack all those risks that are rippling through Asian markets at the moment. Cathay Financial Holdings President also going to be joining us to talk business strategy. And plus, we discuss policy outlooks with the Reserve Bank of Australia and Reserve Bank of New Zealand. Much more ahead. This is Bloomberg.
We're keeping an eye on the volatility index here because as you've got trade tensions and mood swings, I guess, between the US and China very much oscillating, it's certainly playing into the volatility index as well because you're hovering above that key 20 threshold. Yes, you're off that real highs we saw back in April this year, but a lot of analysts are saying it will stay elevated in the weeks ahead. But let's get more on the outlook for trade tensions now, bringing Claire Reade. She's senior counsel at law firm Arnold & Porter, previously served as the assistant US trade representative for China Affairs. So, Claire, thanks very much for your time. We can start on essentially what seems to be tit for tat. You've seen further moves from China around sanctions on shipping in Korea, but US units. You've seen the US also looking at used cooking oil. You're essentially seeing maybe both sides trying to build leverage ahead of trade talks. Is that what we're seeing right now?
Well, it is, I think, in part, but it's also the United States may have missed a little bit of context in understanding what China's doing because the United States put very significant controls on just before China's National Week. And so, of course, there was a delay in China's response. And I think China's rare earth controls were a response to the big semiconductor controls that the United States expanded while China was on vacation. So I think there is a desire on both sides to be seen to be coming into any potential talks with a lot of options for negotiation. But I hope that both sides are clear-eyed about what is going on. And the same thing for China with regard to the U.S. subsidiary of the Korean shipping company. This is clearly a response to the United States, port fees that they just put on Chinese shipping and the other constraints that they just announced. So we just have to see, I think, whether Trump's mood and China's calculations match up, and there's a decision on both sides that they actually want to meet and do something.
Claire, we've seen this kind of tit for tat before, not the least of which was way back in 2016 during President Trump's first term, and even just this week he was posting on Truth Social, it'll all work out. I mean, these two huge economies are in many respects very interdependent, so with that in mind, how does this trade relationship look a year from now?
Ooh, that's a very good question. I think that President Trump has indicated through, I don't know, the way he has approached China, that he does not want to decouple. And I think Bessent, who is a trusted advisor, also doesn't see that as a good idea for the United States national interest. So, and I also think that on the China side, Xi Jinping would like to have a stable external environment so that China can continue to work on its domestic challenges and continue to develop and prosper. So if we look at it in that way, then it seems like there is a common interest in coming to some kind of middle ground. I think, though, that we have to be very clear-eyed about the fact that both China and the United States view the relationship as competitive and do not always view the outcomes as being win-win, for sure. And that concepts of national security on both sides are now much wider. Particularly on the U.S. side, actually, China's always had a very broad definition and vision of its national security, but for the U.S. So I think there's going to be limited ground. I don't think we're going to see a grand bargain. So we could either be in a cold freeze, or we could be in a period of negotiating, or we could have a declaration that there has been a great deal achieved, but it will be a modest deal.
And Claire, just briefly, do you think that if both sides are really quite far apart, does the relationship need to be necessarily acrimonious in that sense, or can you be far apart and still, I guess, be at peace in a way?
Oh, that is a difficult position to be in, particularly when you are constantly bumping into each other in the world, whether it is in the Pacific, around the South China Sea, or whether, which is such an important international, trading route and oceanic route, or it's in the Arctic, or it's in space, or it is proxies with allies or not. I think it's very difficult to be serene with each other. But there could be a kind of kind of cautious truce, I guess I would say, in the best case.
But to your point, Claire, I think many points of friction and certainly going to keep expanding. It was Claire Reade there, Senior Counsel at Arnold & Porter. Thanks for your time. We'll have more ahead. This is Bloomberg. Weakness across Wall Street not translating into Asia this morning. You're seeing here the ASX 200 nearly 30 minutes into the session and climbing up 1% so far. But we are looking to more optimism across the Asia trading session today. Taking a look at Japan assets this morning, and you can see we are setting up for a day in the green, but actually political turmoil that's been one of the major market drivers over the past few sessions is very much going to be in focus today, because you have the main opposition parties in Japan that are looking at the possibility of uniting against the ruling LDP leader Sanae Takaichi. That vote could oust the party from government. The other focus we're going to have for the session today as well is the 20-year bond yield, because we have an auction coming up and investors could end up being quite cautious cautious going into that as well. But let's go to Tokyo and Bloomberg's Japan politics and economics reporter Sakura Murakami. And let's talk about that leadership meeting between the opposition parties, because it is set to happen later today. What exactly are we expecting from that meeting? And as well, could we see a new leadership candidate emerging, do you think?
It's probably unlikely for a leadership candidate to emerge today, but everything is up in the air. There's still a lot of fluidity concerning this. And the main reason for that is because the two kind of focused opposition parties are at odds in terms of policy, namely in terms of energy policy, whether to increase nuclear energy or not, and also in terms of defense and security policy. So this has become a sticking point between the biggest opposition party, the CDP, and the DPP, which is kind of the most populist party out of the three main opposition parties.
And Sakura, in the middle of this, Yuichiro Tamaki's name has come up repeatedly as somebody that the opposition could potentially rally around. So can you tell us a little bit more about who he is and why he's come out on top?
So Yuichiro Tamaki, yes, his name has come up as a potential person who could actually counter Takaichi, who could become the next prime minister if the opposition can sort of rally around him. He's a very populist leader. He's very eloquent. He has a strong internet presence. He's very good at giving sound bites and reaching out to the public. So that's why he's become very popular in recent years. He's actually the most popular out of the leaders of the opposition parties, beating out, for example, Yoshihiko Noda, who is a former prime minister and also the leader of the biggest opposition party, the CDP. So he's kind of the man of the moment at the moment. The opposition parties want to talk to him. Also, the ruling party, the LDP, wants to talk to him as well. The situation right now is very much in his hands, and whether he wants to side with the opposition and potentially become prime minister, or whether he would want to sort of continue talking with the LDP, and it's very much in his hands at the moment.
Yeah, seems like a very fluid situation. So what can we expect then in the coming days?
So at the moment, the LDP has basically requested to hold the parliamentary vote to choose the prime minister sometime next week. So there's going to be, over the next week, a lot of wheeling and dealing, a lot of negotiations, a lot of seeing if there's enough policy alignment to form a government, for example, among the opposition and also with the LDP as well. And at the moment, there's still a lot of fluidity. We're not entirely sure, but the main focus will probably be on Yuichiro Tamaki and who he decides to continue negotiations with, and whether there will be enough policy alignment to actually form a government.
All right, Bloomberg's Sakura Murakami there on Japan's evolving political situation. Other stories that we're following today. President Trump has signaled the $20 billion rescue package the U.S. is planning for Argentina may depend on Javier Milei's success in upcoming midterm elections. Now, the comments triggered fresh jitters in local assets, with the currency swap intended to help shore up Argentina's peso and calm markets. Trump also says the two governments plan to discuss a potential free trade deal. French Prime Minister Sébastien Lecornu has offered to hold off on a law raising the retirement age in his latest bid to restore political stability. The offer comes as Lecornu faces threats from opposition parties to topple him in a no-confidence vote on Thursday. The opposition Socialist Party said it would only back the government if the pension law was suspended. The IMF is warning of dim prospects ahead for the global economy, with signs of strain from sweeping US tariffs and protectionism. Global growth is so far holding up better than expected, with the fund raising its growth forecast for the year slightly to 3.2%. It says this is largely due to temporary factors such as the weaker dollar and preloading ahead of tariffs.
The tariff shock is here, and it is further dimming already weak growth prospects. This is clear even in the US. Growth is revised down from last year. The labor market is weakening, and inflation has been revised up and is persistently above target, signs that the economy has been hit by a negative supply shock.
More ahead on the Asia Trade. This is Bloomberg.
Taking a look at Australia and New Zealand bonds this morning, we are seeing yields moving in slightly different directions here. Not too much movement overall, but the trend overnight was certainly US Treasury yields falling to the lowest levels in weeks, and that was after Fed Chair Jay Powell reinforced these bets that we will see a Fed cut in the October meeting. We're also just getting some lines crossing from RBNZ, or the RBNZ Chief Economist Paul Conway. He's actually speaking at the Citi conference where Paul is, but he's saying he's very confident in the economy's output gap will close, and also that inflation will slow given excess capacity. Of course, New Zealand's economy has certainly been really seeing a lot of recessionary risks that are building for the local economy there, Paul.
Yeah, and Paul Conway is going to be joining me a little bit later on as well, Belle, so we can dig into those observations a little bit more. But for now, let's get some more perspective on the global economy and investment landscape amid ongoing trade tensions between the US and China. And joining us exclusively now from the Citi Australia and New Zealand Investment Conference, we have Jim McCormick, Citi's Chief Global Macro Strategist. Jim, thanks so much for coming down to join us. It's a great time to be a global macro strategist as well, with so much going on, and I want to dig into a lot of the major themes in this conversation, but I do want to start with trade, because we've had the latest tit for tat now, cooking oil versus soybeans. I mean, is this an escalation? Do we sit here tomorrow talking about the taco trade again, or could this potentially get worse?
Well, I think the key point here is I've been making the case for a couple of months that there's a lot of complacency around tariffs, and it's really two-dimensional. One is that people think there's been no economic impact, and therefore there won't be any economic impact, and it takes time. And so I think we'll see a lot more impact on inflation and growth going forward. But the other issue is that there's been slow but steady escalation for the past couple of months. I mean, Trump has been putting his Section 232 sector tariffs in play. Behind the scenes, China and the U.S. have been doing some tit for tat. So, and I know all the excitement in the market was around, I'm going to do 100% on China, but if anyone was really paying attention, which no one really wanted to, the escalation was picking up for the past few months.
Well, we have been here before, though, haven't we? Because in 2016, in the first Trump administration, we saw similar sorts of trade tariffs. Are there any valuable lessons from history, or is this time different?
I think this time is completely different. I mean, even if you look at the size of the tariffs, I mean, back then, the effective tariff rate barely moved. This time around, the effective tariff rate has gone from 2% to 18%. So it's much bigger. It's much more organized. It's clearly meant to last. And I think the market is struggling in terms of how to discount that. And all I can say now is, again, I think when I look at market pricing, when I look at volatility levels, it's far too low relative to the underlying risks that are building around the tariff issue.
One of our guests yesterday characterized the tariff issue, and in particular rare earths, as a rare earths Cold War. Would you share that view, and how damaging could this be to global growth?
You know, I think that's right. I mean, if you look at Trump's long-term ideology, the real plan was strategic disengagement from China. And the kink in the road was clearly that China has been spending the last couple of decades basically monopolizing the refining of rare earths. So that has been the sticking point, that if it were up to Trump, the escalation would be much, much bigger. The tariffs would be much, much bigger. But what he's learned is it's quite difficult to do that when China has a monopoly on 90% of all the rare earth refining in the world.
Well, of course, trade's just one macro risk. I mean, we've forgotten that there is still a major war raging in Europe between Russia and the Ukraine. There is still a shutdown in the US. The Japanese and French governments are in turmoil. We had a Bank of America survey today warning of AI bubble risk. So do you have a sense that the bad news is kind of starting to pile up? And can this rally continue in the face of it?
Yeah, I'm a little bit wary of the rally. And again, the way I think about it is I do look at implied volatility levels. And by 2 weeks ago, we were sitting across every financial market at the lowest implied vol in months, if not years, in some markets. And given the risks around everything, there's a mismatch. So I do think that the fourth quarter is going to be very different in flavor, much more volatility. I'd be wary of chasing these equity market, credit market rallies because there are a lot of macro risks out there.
Well, there is a sort of broad general assumption that the only thing that really undermines a bull market is a recession. Do you think that's true? And if there isn't a recession on the horizon, is there any reason to think that this bull market couldn't keep going?
No, I mean, listen, I think it's absolutely true that ultimately the thing that will kill off this rally is a recession. And frankly, I don't see a lot of recession risks out there. I mean, I think even in the U.S. economy, there's worries about jobs growth, but if you look at activity elsewhere, it looks okay. It's soggy, but it doesn't look recessionary. But I guess the question for investors would be, are you prepared for another 10 to 15% correction? And if you are, fine. You either hold on to it or you buy the dip. But 10 to 15% corrections are pretty painful, and that, I think, is the risk we're looking at as opposed to a genuine recession risk.
One of the things helping support this rally is, of course, the easing that we've seen from the Fed so far. We're anticipating more to come, and remarks from Jay Powell today suggesting that the jobs market is assuming a greater influence on future policy decisions. Do you agree with that, and do you feel inflation's now under control in the U.S.?
You know, listen, my view on the U.S. and the Fed is that the Fed is turning increasingly dovish. Part of that is being driven, I think, by pressure from the Trump administration. So the focus on the jobs market isn't unreasonable, but we are in a world where inflation is rising. And to me, the biggest risk out there, forget about Japan and France, and the biggest risk is that the Fed over-eases into a rising inflation environment, and we see a significant sell-off in the long end of the U.S. bond curve. That would be the thing that worries me most.
What about debt and deficit in the United States in an environment of an ongoing U.S. shutdown and no real fiscal motivation to do anything about this problem? And I think partly this is being reflected in the gold price. Does this worry you, the amount of debt accumulating?
I mean, I'm usually a wall of worry, and I've worried about fiscal policy in advanced economies for the past 3 years. And when I speak to investors these days, there seems to be a lot less worry about U.S. fiscal policy. I'm not sure why that's the case. And the only thing I'd say about the shutdown is that the core of the shutdown is a really interesting fiscal issue, which is this is all about healthcare spending. The Democrats are trying to stand up for healthcare spending. The Republicans are trying to cut healthcare spending. And if the Republicans have to compromise, I think that's going to be a moment where people realize that the U.S. fiscal problem is still a clear and present danger.
You said a moment ago, forget about Japan. I can't. I'm sorry. I've got to ask you about it because we could have a situation where the government changes without an election. How closely are you watching this situation unfold? What are the permutations for you?
Yeah, I spend a lot of time looking at Japan, so I need to be clear that you need to keep watching it. I guess, listen, there is so many potential paths for market volatility from Japan. One potential path is we don't know what this government's going to look like. The uncertainty around Japanese politics is higher than it's been in years. The worry the market has, which I think is a reasonable worry, is that whatever combination we get is going to spend a lot more fiscally. So you're seeing a big sell-off in the long end of the JGB curve. The other thing I worry about is that the market assumes that the politics are taking BOJ rate hikes off the table. I think that's wrong. So we can easily find ourselves in a situation in the next few months where the market's priced out BOJ rate hikes, the BOJ does hike rates, the currency rallies, and we see a repeat of the volatility that we saw last summer.
Jim. We're out of time, unfortunately, but that's really great analysis. Thanks for joining us today.
My pleasure.
That is Jim McCormick, Chief Global Macro Strategist at Citi. And we have more coming up from the Citi Australia and New Zealand Investment Conference. In the coming hour, we're going to be talking inflationary risks with the Reserve Bank of Australia Assistant Governor and Chief Economist Sarah Hunter. Also, the RBNZ's Economics Director going to discuss the outlook for growth and inflation in New Zealand. Bell.
Thanks, Paul. Yeah, really great interview there. And we just got some breaking lines as well crossing the terminal. This relates to Apple. And what we understand is that they're preparing to expand their manufacturing operations in Vietnam. This is from next year. It is part of a push that they're making into the smart home market and also into ongoing efforts to loosen their dependency on manufacturing in China. So the company is looking at developing a range of new home devices from next year. That does include indoor security cameras, a display designed to control appliances. There's a robot that moves into the equation as well. But all of these products are on track to be built in Vietnam, and the company is also going to be teaming up with BYD, as of course a Chinese firm, but with BYD to manufacture these products. So that's what we're getting so far. Again, it is not confirmed by the company for now, but it is a scoop that we've got from Mark Gurman, our Apple reporter. So we'll have more details on that just ahead. This is Bloomberg. The billionaire investor Tudor Jones expects the Nasdaq to climb higher by the end of the year. However, he told Bloomberg that he's nervous about the concentration risk in US equities, particularly around the so-called Mag 7.
My concerns are I see concentration risk everywhere I look. When now we have individual investors with the highest equity allocation they've ever had in the history of the United States, really 4 times that of the rest of the developed world. So I get nervous about that concentration. I get nervous about the fact that we have 35% of the S&Ps now concentrated in 7 stocks. I get nervous about the fact that this administration, even if all those decisions were smart and correct, again, if you just think about the number one rule of portfolio management is you want diversification. That's why our founding fathers created us as a democracy, not a monarchy, because you want that contestation of ideas. So I'm nervous when I see concentration virtually in anything. Again, whether it's in the stock market, whether it's the composition of the stock market, who owns the stock market, or the decision-making that's getting made in Washington. It makes me nervous because I don't think in the long run, right? Even if all the decisions that President Trump is making are great, is that going to embolden the next president, who may not make as good of decisions, to do the same thing? So I'll look at that, and again, it raises caution flags for me.
But you're still long stocks right now? You're still long the NASDAQ?
I wouldn't say I'm long at this second. I'm clearly, again, I think there's such a confluence of possibly negative, possibly positive events. I think I want to kind of wait and see where we are in a week or two time. But my belief is that we'll be substantially higher by the end of the year.
That's Tudor Investment Corporation's Tudor Jones speaking with Bloomberg's Matthew Miller there. Right, let's talk a little bit more about Japan and check on how Japanese markets are shaping up ahead of the market open. Stocks reporter Alice French joins us now. Alice, just a moment ago, speaking to Jim McCormick, the Chief Citi Global Macro Strategist, he was saying there's so many paths for volatility in Japan. What are investors watching at the open here?
Morning. Yes, absolutely. Which, of course, it's somewhat uncharted waters, I think, for quite a lot of investors in Japan, as people have been obviously used to that stability, right? So things are definitely changing. And the trade issues, the kind of US-China fallout that we're seeing, we definitely saw that impacting stocks yesterday afternoon, particularly those kind of China-exposed names in things like factory automation and industrials, really losing some ground yesterday afternoon. Now, futures are pointing to a mild rebound this morning, which I think wouldn't be surprising considering considering the sell-off that we saw yesterday. But of course, investors will be monitoring any developments on that trade front. You know, it's worth bearing in mind that the rally that we've seen in Japanese stocks so far in the last few months has largely been driven by expectations that, you know, tariffs won't be as perhaps as hard as people had been worrying. And obviously we had that US-Japan trade deal that really gave equities a boost. And so any kind of sign of tension or worries around trade is bound to hit that risk appetite. And then, of course, you know, it's impossible to ignore what's happening domestically with the political situation too, and we'll be following any developments in that as well.
Yeah, on that domestic front, as Paul was saying, there's just so many different paths that it could take. So as someone who's following the stocks market as closely as you, how do you judge where the trading activity is going to go from here?
Yeah, I mean, of course, we know there's going to be this meeting of these opposition parties happening later today. So, of course, investors will be watching closely, sort of, does it look like there could be a coalition that could, you know, come up and potentially challenge the LDP? Of course, all of this just means a lot of uncertainty around where policy is going. And we know that we have a BOJ meeting coming in just a couple of weeks' time. You know, banking stocks, I think, are something that are really going to potentially take a hit here in terms of that uncertainty. Will we get a rate hike this month? Won't we? What might we see one again, kind of amidst all of this uncertainty? So I think banking stocks will be something to really watch for, sort of how the market mood is going. But I think at least in the short term, we can expect a lot of sort of wait and see trading. I think it will be difficult for people to kind of go hard in on any sectors. Having said that, you know, the yen is still looking pretty weak, and that does tend to obviously support equities. So there will be some downside support there. But I think at least in the short term, we're going to be seeing kind of a lot of jitters, and I think it will be difficult for us to kind of get back on that track of rally that we had seen. But of course, we're still up around kind of record highs. We still have tailwinds from things like corporate governance going on in the background. So, you know, all is not lost, but I think definitely the political situation is going to be a concern going forwards.
Yeah, and just to note, we've got the banks index, the Topix Banks Index, off around 5% over the past 2 sessions alone. That was our Japan stocks reporter, Alice French, there. And some of the other sectors we're going to be watching when the trading opens in Korea and Japan shortly. Well, crypto stocks really the ones to track in Tokyo. That's particularly Bitcoin Treasury, Metaplanet, after we had the Nikkei reporting that Japan's going to be imposing new rules that ban cryptocurrency insider trading. On top of that, you saw cryptocurrencies continuing to lose ground after a historic round of liquidations triggered a sharp sell-off last week. That's as trade tensions weighed on risk assets, and Metaplanet's enterprise value has now dipped below the value of its Bitcoin reserves. We'll also be monitoring how Hanwha Ocean trades today after we had China putting sanctions on US units of it. This is the Asia trade. We're counting down to Asia's major market opens. And Paul, Monday was all about the taco trade. Yesterday we had trade tensions back in focus, or at least on the Wall Street session. Today it seems like Asian investors might sort of be able to put those to the side a little bit. We are setting up for a day in the green.
Yeah, that's right. But there's a bit of a roller coaster on the trade front. It's hard to know what to expect next. Does it escalate? Does it de-escalate? But also interesting situation in Japan. The potential now for coalition talks between opposition parties and maybe even a change of government without an election. The 20-year auction a bit later on today is going to be an interesting one to watch as well.
Yeah, certainly going to be tracking the demand for that very closely. But as you said, and as you were speaking with the Citi Economist in the last hour, there's really a lot of different directions that Japan's political spectrum can take. But just at a headline level, and we are going to dig into the details in a few minutes, but the main opposition parties in Japan are discussing the possibility of uniting against the ruling LDP. So that is certainly going to be playing into the dynamic today. We were just speaking with Alice French just in the last few minutes as well, our stocks reporter, also taking a look at some certain sectors given that you've got this outlook for the BOJ also not looking very clear, again playing into that 20-year auction today possibly, but essentially, will we see any sort of further easing? When would that come as well? And you're continuing to watch the Japanese yen there tracking back down below the 152 mark. Japan stocks, though, they are moving to the upside. You've just got them coming online. The Nikkei 225 up 0.3%, but as we said, banks going to be one of the key sectors to track. Let's shift on, take a look at what's happening in Korea this morning, because really at the start of the day, there's a couple of different stocks to watch very closely. So Hanwha Ocean is certainly one of those. Again, this is very much a trade tensions related story, because we saw China essentially pushing back against the US yesterday, sanctioning some of its US units linked to or with of Hanwha Ocean, rather. This stock, though, again, it's moving a bit to the upside. Korea Zinc, I mean, you're setting in for another day of very solid gains here, because we saw Korea Zinc shares soaring yesterday, and that's after local media reported that China's curbs on rare earth exports could boost the company's profit. So again, you're seeing strong upside here in the session, and the Kospi overall in the green. ASX 200, you're 1 hour into the session today, and again, it's another day of positivity here. You can see we are seeing also for the S&P 500 futures looking relatively positive. The 2-year yield very much one to track, and that was after we saw it retreating back down. We had Jay Powell speaking overnight, reflecting on the conditions of the labour market and also pushing back, or at least setting traders' expectations of a further cut in October. But take a listen.
The labour market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So, those two states of affairs for our two goal variables, call for different monetary policy responses. So, as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out.
Let's get more now with Garfield Reynolds, who leads our Markets Live Asia coverage. And Garfield, I want to start with the latest development on the trade front. I mean, just a few hours after saying it'll all work out with China, don't worry, President Trump talking about, maybe cooking oil is on the table now in terms of trade reprisals. So what is the market to make of all of this?
Well, Paul, I think the market is actually getting a little bit calmer out of all of this, because Trump's going from, we're going to add 100% tariffs, definitely, to, well, maybe we will, maybe we won't, and maybe we'll punish China with cooking oil sanctions. That sounds a lot less dire, I think, as far as markets are concerned. And it's a very small amount of bets there, but Polymarket is sticking with only a 15% chance that you do get those 100% tariffs. So there's a tendency out there for investors to look through the more severe threats from the US. The bigger concern is, do we get a Xi-Trump meeting? Do we get some sort of a trade détente staying in place between the two, even if China's stance is perhaps looking a little bit firmer than it was? So that's the question investors are looking at, and I think they're mostly looking at it with the idea that over the coming days, a confirmation of a China-US trade détente is the base case. And Trump may huff, he may puff. He's not about to blow the whole house of cards all over the shop. Really mixing my metaphors there.
I like it. But Garfield, what do you make then of the trading activity? Of course, it's just the very early moments, but it does seem at least that Asian investors are putting the trade tensions to the side. Do you think that people are more focused on what Jay Powell said about the direction for the Fed, or do you also think corporate earnings and the bank's picture is playing into it?
Well, I think both of those factors are at play, but the most obvious one, the one that really matters, especially as far as global investors are concerned, is the Fed. And Jay Powell's comments were very much designed to reassure risk appetite in general by making it clear that a 25 basis point cut which is what the market has been expecting, is pretty much locked in for the end of October. It would take some extraordinary developments to throw that out the window, and that's very much what investors are wanting to see, a gradual reduction in US interest rates. No panic. Panic would signal the US economy is in deep trouble, which is nobody's base case at the moment, but it also would mean that the Fed is determined to avoid a policy error, to avoid setting off that sort of panic. So that being the case, I think Powell's comments are, they're the source of a stable bid for risk assets at the moment.
That was Garfield Reynolds there, who leads our Asia MLive coverage. And just as we've been speaking, we are over 5 minutes into the session so far, and there's a stock we're watching in particular here. This is Metaplanet. After we had the Nikkei reporting in Japan that they're going to be banning insider trading for cryptocurrencies. So the Metaplanet value has fallen below its Bitcoin holdings, though, for the company. Still, we are off around 2% so far. So it is going to be one of the main areas to watch in the session today. Again, that cryptocurrency story. But the other story we're going to be tracking closely as well is what's happening in Japan and the political spectrum, because the opposition parties have agreed to continue discussions on uniting against LDP leader Sanae Takaichi. That's in a vote that could oust the long-ruling party. Let's go to Tokyo and Bloomberg's Japan politics and economics reporter Sakura Murakami. So, Sakura, let's just start with the bigger picture here. How exactly have we come to this position, and what can we expect when these opposition parties meet later today?
So the reason why we're here is because the ruling coalition between the Komeito and the LDP sort of fell apart last Friday. And so the LDP currently has 196 seats out of a majority of 233. So they're in a very weakened position. And this means that if the top three main opposition parties come together, they can get 210 seats, putting them at a higher chance of actually being able to elect the next prime minister and also form a government. So that brings us to today. The leaders of the main opposition parties are going to come together to have talks and see if they can hash out the differences between their policies. The main opposition, the biggest opposition party, the CDP, is very much focused on a change in government. They want to see a change in government. They want to do whatever it takes to actually see the opposition actually choose the next prime minister. But the other opposition parties, namely the DPP, isn't quite on board with that yet. So we'll see how these talks play out today.
Sakura, is there enough policy common ground between those three parties to actually pull off a change of government without an election? And were it to happen, what would be the implications for fiscal policy?
So there is common ground. The main issue in Japan right now is inflation, and the top contender to actually become the lawmaker that the opposition can rally around is Yuichiro Tamaki. And his main message over the past few years has been increase take-home pay, alleviate the burden of inflation on households. And that is actually a message that all the opposition parties can rally around. So there is common ground, but in terms of the wider vision of the country, for example, defense and security policy or energy policy, especially in terms of whether to increase nuclear power or not, there are differences there. And Tamaki is basically saying these are issues that there has to be 100% alignment on. And unless there's alignment, a coalition can't be formed. So that's where the point of the talks will be. And either way, in terms of the long-term impact of these talks, even if the opposition does come together, they're still going to be short of a majority. And that means just long-term instability either way. The man of the moment is Tamaki, and a lot is on his shoulders right now, and how he decides to play his cards and how the talks today play out as well.
All right, Bloomberg's Sakura Murakami there. President Trump says he might stop trade in cooking oil with China as retaliation against Beijing for its refusal to buy American soybeans, which he calls an economically hostile act. Now, in a post on social media, Trump said the U.S. can produce its own cooking oil. Let's bring in Bloomberg managing editor Jill Desis with more on this. So, Jill, where do we head from here? Is this the first stage of another escalation, or are we sitting here tomorrow talking about another taco moment?
Well, I think, Paul, when you take this in context with what else we've seen in this tit for tat, particularly over the last week or so, we've really seen an escalation in these tensions between the U.S. and China. So just yesterday, there were various measures announced about concerning maritime regulations. We had China talk about some curbs on shipping related to some subsidiaries of a South Korean company that were operating in the U.S. We've also seen a lot of concerns over rare earths exports. That's something that China really tightened the screws on last week. So I think at this point, we're really in this evolving tit for tat. Obviously, we've got this latest threat from Trump concerning cooking oil. I'm not sure when you're looking at how much leverage the Trump administration necessarily has when it comes to cooking oil compared to China withholding these purchases of U.S. soybeans, that's really kind of on the level there. But ultimately, I think it just indicates that these tensions continue to rise. Others within the Trump administration have tried to temper down things, saying that negotiations continue ahead of this pretty highly anticipated meeting between Trump and Xi expected at the end of this month. But yeah, I think we'll ultimately have to see where things go from here. And the takeaway at this point is that tensions really still do exist between these two economies. We'll see how much they can actually negotiate on trade.
Yeah, and tensions also between the EU and China. What do we make of that scoop we had around possibly looking at forced tech transfers in the European Union?
Yeah, so Annabelle, I think the important thing to remember there is the idea is that the European Union is mulling the idea of forcing those Chinese companies, if they would like to operate locally in Europe, to sort of hand over these technologies. I think in order to really preserve the competitiveness of European companies. When it comes to Europe, I think again, some of this really goes back to that issue on rare earths that also does affect the EU as well and some of these other major Chinese trading partners. I mean, the idea that China could be curbing exports involving, even trace amounts of these materials, which are really important for the development of everything and advanced technologies from fighter jets to electric vehicles, I think has the potential to really disrupt a lot of trade around not just America, but Europe as well. So I think that's where you're seeing Europe kind of explore the idea that it could be looking at something, that can be, some sort of whether it's a retaliatory effort or some way to protect their own business interests. That's, really where things stand when it comes to the EU.
Jill, thanks so much for joining us. That was our Bloomberg managing editor, Jill Desis there, and we'll have more ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade this morning, and we are 15 minutes into the session for the Nikkei and also the Kospi. And you can see here gains across the screen. It's not really what maybe could have been expected, given we saw weakness on Wall Street overnight and investors really clinging to these renewed trade tensions between the US and China, and certainly a ratcheting up of the tit for tat. But in the session today as well, traders do seem to be paying a lot of attention to what Jay Powell said. We saw that Treasury 2-year yield pulling back and bets certainly being reinforced that we are going to see Fed easing in October. Let's also shift now to the Cathay Asset Management Summit that begins in Taipei today. It gathers executives from top global investment firms to discuss navigating this current market environment. The China Show co-anchor or co-host Yvonne Mann is standing by with our first guest from the event, Yvonne.
Yeah, Bella, you talk about booming stock markets in the face of all these geopolitical concerns. Really is the forefront here in Taiwan, right? Because this whole AI trade, you're still seeing this equity market near record highs here right now. And what that has led to is just a lot of new wealth has been created here in the region. And what local asset managers want is to keep that sort of wealth onshore. Regulators have been pushing for this here, this so-called wealth asset management kind of hub that they want to build in Taiwan. Taiwan. This project has been kicked off for some months now in the southern tip of the island in Kaohsiung, and it's kind of the sandbox where they're relaxing regulations, providing more wealth management products, as well as loosening restrictions on banks. Part of that, of course, is really what asset managers see the vision behind all this, and I'm pleased to bring in Cathay Financial Holdings President Chang-Ken joining us here to kick off our coverage here of the event. CK, it's great to have you. It certainly sounds very promising, building this, Taiwan has its silicon shield, to building this financial shield. Well, it's promising, but what's the potential, do you think, of Taiwan becoming a regional hub?
Okay. I think this is a very good project for Taiwan at this moment. Sorry. Because in Taiwan, the financial system somehow is very stable and very prudent. But somehow regulation is very rigid. But this time, Financial Supervisory Commission launched the Asset Management Center project in Kaohsiung Financial Special Zone. We are very excited about this project because you can see Cathay Financial Holdings from the beginning. We utilize we call dual engine strategy for the group structure. But we feel suppose we can transfer to be a 3-engine structure, including banking, insurance, and asset management. That should be very, very good. We will take this time, try to transfer the group structure. So we put a lot of efforts, try to build the Cathay site as an asset management platform. So this time the FSC not only encourage a financial institution to develop private banking business, family office business, they also encourage a life insurance company to move their assets and professionals to site. So
how much do you think it could grow in terms of AUM?
Well,
what targets are you set now?
So far, the Cathay site is even around 2 trillion NT dollars. Suppose plus around 6 to 8 trillion NT dollars from Cathay Life and professional. Suddenly, the Cathay site will become a sizable site in the region. So we try to make Cathay site be stronger and bigger, and they are stronger enough to manage the local and international third-party assets. This is a very, very, very exciting moment for Cathay Financial Holdings.
Yeah, it certainly has its potential, right? But also, Taiwan does have its sort of hurdles that it has to overcome. I mean, for one thing, there's higher taxes here. Yeah. There are capital controls around the Taiwan dollar. Yes. Also, there is geopolitical uncertainty with China as well. Do you think this project counteracts some of those challenges? Well,
actually, for the tax, for the currency control, somehow this is weakness for Taiwan. For the geopolitical risk, somehow some investors will have concern. But I think this time the most important thing is the deregulation. So through deregulation, you can see we have a lot of new business we can do. Those business actually we try to do, but we cannot do it before. But this time, those deregulation would help a lot. You can see so many local and international business in Taiwan. They try to set up operation in the Kaohsiung special zone. So suppose there's no attractiveness, why so many financial institutions rush into the Kaohsiung financial special zone? So I think that you can imagine the government tried to develop the asset management center for more than 20 years. Yeah. But we haven't achieved it. Just you mentioned. Yeah. Several issues we still facing today. But I think this time, because the FSC is very proactive, right, and also encourage all the financial institutions to participate. And I think at least Financial Supervisory Commission had earned the confidence and the admission from the financial institution and public.
And the regulators at the FSC has been urging, I guess, a lot of the life insurers to really put mandates into local asset managers, yeah, right? They're talking about, what, 1 trillion NTD really for the first year or so. I'm just wondering in terms of what Cathay's plans are. Mm-hmm. We're hearing chatter that the life insurance unit might be folded into your asset management arm. Mm-hmm. Can you confirm that with us? What's the strategy moving forward?
Well, actually, in Taiwan, because the site is regulated very rigid. For example, in Taiwan Financial Holding Company, our employee actually they can be employee on the other subsidiary, but for site, no way to do that. But this time, suppose they can deregulate, and then we can move all the professionals, several hundred people from Cathay Life to site. Actually, that will enable Cathay site capability very well. So I think this is the moment for Cathay Life and Cathay site. They can work together. So
how much in terms of assets will Cathay be mandating eventually?
So far, it's not a big number, but I think we will.
What is that number? Can you give us a rough number?
I think it's around. Let me see. It's around. It's around 200 billion NT dollars around. But we are gradually to shift all the assets from Cathay Lab to Cathay site.
Okay. Does that actually do anything in terms of changing how much the foreign asset managers get? Does that chunk get moved around? And does it really actually boost AUM, this sort of move that you're seeing?
I think this is not only boost the AUM. The most important thing is the professional and the mindset. Because for life insurance company, they are really good at the long-term asset management.
Yeah.
So, for example, Cathay Lab, they deliver very good performance for a very long term. So such capability, they move to Cathay side.
Yeah.
That'd be really, really helpful for them.
Okay, CK, it's great to have you. We ran out of time, but yes, CK Lee there joining us from Cathay Financial Holdings President, joining us here at the event. Back to you, Belle.
Great interview, Yvonne, and also a lot more coming up from the event. That was our China show co-anchor, Yvonne Mann, there at the Cathay Asset Management Summit in Taipei. And we'll have more ahead on the Asia trade. This is Bloomberg. Well, the top global headlines we're following this morning, and President Trump has threatened Hamas with retaliation if the Gaza-based group doesn't lay down its arms. Trump says disarmament needs to happen within a reasonable time period. Meanwhile, Israel says it's limiting aid into Gaza because Hamas has yet to return all the bodies of dead hostages, a key part of the deal that took effect last week. President Trump has signaled the $20 billion rescue package the US is planning for Argentina may depend on Javier Milei's success in upcoming midterm elections. The comments triggered fresh jitters in local assets, with the currency swap intended to help shore up Argentina's peso and calm markets. Trump also says the two governments plan to discuss a potential free trade deal. French Prime Minister Sébastien Lecornu has offered to hold off on a law raising the retirement age. That's in his latest bid to restore political stability. The offer comes as Lecornu faces threats from opposition parties to topple him in no-confidence votes on Thursday. The opposition Socialist Party said it would only back the government if the pension law was suspended. Let's take a quick check on European futures here, because we haven't really seen actually that much market reaction from what's happening in France. Political turmoil not looking like market turmoil just yet, but a quick check as well on German futures, because of course the big story overnight as well was possible forced tech transfers from China. Taking a look at Aussie assets here this morning. We're 90 minutes into the session, and you can see gains for the ASX 200. Pretty much every sector in the green today. So it does tell us that investors seem to be putting aside trade tensions. We saw more tit for tat between the US and China overnight and yesterday. But we did also hear from Jay Powell a few hours ago, and he signaled that essentially there's this expectation we're going to see further easing in October. That certainly remains the base case for now, Paul.
Well, our next guest says Australia's underlying inflation in the 3 months through to September is likely to be stronger than the central bank had anticipated, suggesting the labour market and broader economic conditions do remain tight. Joining us now is Sarah Hunter, Chief Economist and Assistant Governor at the Reserve Bank of Australia. Sarah, always a pleasure to be able to speak to you. And you were making these remarks just a few moments ago here at the Citi Investor Conference. Brace for potentially higher than expected core inflation. Can you unpack that out a little bit for us. What are you expecting and what's driving that?
Yeah, so we're looking at the same data everyone else is, but we've had now 2 months of the monthly indicator for the 3 months of the September quarter. And there's just a couple of categories that look like they've come through a little bit stronger than we were anticipating. The first of those is housing. So that's an amalgamation of rents and in particular new dwelling construction costs. And the second is market services. And those ones are particularly important because they are, core components of the CPI. They will come through in the trim mean. And so we're just monitoring those two, but given that they've printed through a touch stronger than we expected, we think that will then show up in that full quarterly print that we get at the end of October. So
how much weight do you think the board is going to be placing on that before deciding its next move?
Well, I mean, all data matters. All data is important. Obviously, inflation data is very important because it's it's core to the mandate of us keeping inflation in that 2 to 3% target band on an ongoing basis. So yeah, definitely it's going to feature. Of course, we also, as part of the November meeting, will be publishing on the day of the meeting itself our updated forecasts in our November SMP. So they'll also get that information as well. And obviously, everyone else will too. And that will give you a real sense of how we've read the data, whatever it turns out to be, and what it means for the outlook.
Yeah, I want to talk about the forecasts a little later, but just circling back to that point that you made about house prices, and this is something we typically see when we're in an easing cycle. House prices tend to go up, often has an impact on rents as well. So what are the recent pickup telling you about getting inflation back to target?
Yeah, so house prices specifically, of course, they're not directly in the CPI, but they are one of the first, typically, domestic transmission channels for monetary policy. So it's not a surprise that since we started cutting rates in February, we've seen a little bit of a lift in the momentum in the housing market, and that's come through in prices. And then we'll expect to see that transmit through into new dwelling construction activity. So the viability of projects improves and lift in demand for dwellings, and that will come through into construction over the forecast. And then also it'll flow through a little bit into consumer spending as well via a wealth effect. So we're really monitoring that channel and thinking about what that then means for inflation. We're not surprised that we've seen the pickup because we've seen it before in cutting cycles. So what we've seen isn't out of line with previous periods. But obviously we're monitoring it, and it's really, for the board, what they're really focused on now is keeping inflation around about the middle of the target band, particularly that underlying trim mean metric, because that's our best lead for where headline inflation will be over the medium term.
How much confidence do you have that inflation will be in the midpoint of that target band by 2026?
Well, look, forecasts, inevitably you get things a little bit wrong at least. Sometimes you get them quite a lot wrong. And so that's the job for me and my team, is really looking at what's happening, updating our forecasts, taking on the new information, taking on what's happening around the world as well, and what that actually means for the outlook. But obviously, that's very much what we're trying to achieve. That's what we want to achieve. We've got to a point now where obviously we had that trim mean inflation was 2.7% in the June quarter, and the labour market had been, we think, relatively stable in recent months. We really would like to keep it there, trim mean around the middle of the target band, headline eventually there too, and the labour market stable. But we've got to respond to what the data tells us, and what else might be happening that we didn't foresee, and you can always get surprised by shock. So that's the job, and you're forever looking forward, and things are always changing. But I hope that I can come back in a year and that's what we've achieved, but let's see.
Well, you might be helped along the way, because I know you've been putting a lot of work into getting more detail into the monthly inflation data that we've been receiving, so instead of the quarterly prints that we've been getting. How significant is that in terms of your forecasting and helping the board make decisions?
Oh, look, it's a fantastic step forward, a really great step forward. It's not even once in a lifetime, it's once only. So it's incredible to see that happening now. So grateful to colleagues at the ABS for all the work that they've done to get that full monthly CPI up and running. So it will give us more information in every month, and it will obviously go into our forecasting process from the off. Having said that, we do know that for just a relatively short period of time, there's going to be a bit of a transition. The ABS are still working through what the seasonal patterns look like for all of the components of inflation. That's important because we want to look at inflation on a quarter-to-quarter perspective, because that gives us the best read on the latest sort of impulse. So whilst they're doing that and just figuring those things out, we're also going to keep paying attention to and really focusing on the quarterly trim mean. So we're going to use them both together through to at least the middle of 2027. That's that transition period. But look, in the beyond that, into the medium long term, this is an incredible step forward. We'll make our jobs certainly more information. I'm not going to say easier, but we'll have more information to work with, and that can only be a good thing.
Always helps with forecasts. And in terms of forecasts, can you tell us a little bit more about your growth expectations and some of these unknown factors as well in terms of the risk around the global backdrop?
Yeah, so starting with the global backdrop, it's certainly still uncertain and unpredictable. We've seen just in the last few days a re-emergence of some of the trade tensions that we thought maybe were a bit closer to resolution. And so we're clearly paying very close attention to that. And to seeing what's happening in other countries around the world. We can see the US labour market, for instance, looks like potentially it's softening, and the uncertainty impacts may be playing through there. So that's certainly one aspect that we're paying attention to. In terms of the domestic outlook, we thought back in August that GDP growth would get up to around about 2% a year by the end of this year and sort of hold at that rate through the forecast horizon, more or less. And that's really consistent now with our updated assessment of what we think the sustainable pace of growth is. So that's the pace the economy can manage without generating inflationary pressures. And so really, if we can achieve that and we keep inflation round about the midpoint of the target and the labour market in balance, then that's what we're looking to do. So we think that that's what we thought in August that we'd see for an outcome, but obviously we're working through things for the November release.
And linked to growth, the question of productivity, and this is something the Treasurer talks about a lot, and in fact everybody talks about a lot in Australia. Do you feel the settings are right to improve productivity, and what's your outlook around that?
Yeah, well, so in terms of the settings, obviously there's a lot of focus on it at the moment, and it will be really important to see what comes out of that and what changes can be made, not just by government, but by the private sector as well. In terms of our assumption at the moment, so we just recently downgraded our medium-term assumption for productivity growth to 0.7% a year from 1%. But I want to stress that that's our assumption for the next 2.5 years. Through to end 27 is our current forecast horizon. And the reason we focus so near-term, short-term, if you like, is because that's the horizon the monetary policy has an impact. But a lot of what we're talking about in terms of changes to productivity settings, they have an impact 3, 5, 10 years down the track. That's true of the rollout of AI. It can be true of some of the changes that might be made around regulations and planning and all those sorts of things. So we're going to be revisiting this assumption on an ongoing basis. We're not saying anything about what productivity growth could be in 2030, 2035, 2040 or anything like that. We'll be updating and we'll all learn as we go about what that outlook looks like going forward from here. But just in the recent past, and we think for the next couple of years, it's a little bit softer than it has been previously.
Well, of course, another part of the RBA's mandate is the labour market, and it is kind of telling that we've left this right to the end. And does that suggest things are really under control? You're comfortable with how things are looking in the jobs market?
It's certainly very pleasing to see that we've been able to bring inflation down, say to 2.7% for underlying, with not too much of a lift in the unemployment rate. We know that that softening is challenging for some people, and we're alive to that. But it is really good that we've been able to preserve those gains in the labour market. So the question from here is, where does the labour market go relative to inflation? That's something we're really working our way through at the moment. But certainly, as the Governor has said, it is really good to see that we've still had very strong employment growth over the last couple of years and a relatively small lift in the unemployment rate.
Yeah, and we will get some labour market data tomorrow.
We do, yes.
Just finally, heading into 2026, looking into your crystal ball, what's the biggest risk Australia faces?
Oh, what a good question. It is a bit hard, I think, to walk away from what's happening internationally and the many different ways that might play out. So I think we'll be very focused on there through 2026. I think domestically, the risks are definitely quite balanced at the moment. There's reasons to think maybe the pickup in consumer spending we've seen isn't sustained. That's a risk that we're certainly focused on. Equally, we've already talked about that sort of upside, a potential upside to inflation and risk to the upside that might occur there. So we're looking on both sides of the ledger, as we always are. But those are, I guess, three of the things I'm certainly looking at from here.
Sarah, thanks so much. We always appreciate your time. That is Sarah Hunter, Chief Economist and Assistant Governor at the Reserve Bank of Australia. We have more ahead on the Asia trade. This is Bloomberg.
Taking a quick check on Kiwi assets this morning. Again, you've got Kiwi stocks that are following the broader trend in Asia, which is moving to the upside. So it's that bigger focus that we're seeing on expectations around Fed easing. We had Jay Powell, for instance, overnight talking about, or really reinforcing the case that we're going to be seeing Fed easing at the upcoming meeting in October. But Paul, we've also been hearing about New Zealand's economy from the RBNZ chief economist.
Yeah, that's right. New Zealand Central Bank, of course, did cut interest rates last week a lot more aggressively than most forecasters were expecting, also saying that it's open to further reductions as well, and that underscores mounting concerns about the economy. Well, our next guest, though, remains confident that inflation will slow and that the 2.5% rate is towards the lower end of the neutral zone. And joining us now is the RBNZ chief economist, Paul Conway. Paul, thank you so much for giving us some time today.
Pleasure, Paul.
I just want to pick up on that point that you made to the conference here earlier. You're confident that the output gap can close. What gives you that confidence?
Well, that's how these cycles normally play out. So we've done 300 basis points of easing in a little over a year. As you mentioned, we went 50 basis points last year, and I think that was more about addressing the balance of risks, which shifted on us with that negative 0.9 Q2 GDP growth in the second quarter of this year. But the 50 points kind of offsets that, I think, to some extent. So we're expecting a modest pickup in growth over Q3 and Q4 into next year as that output gap closes.
I want to talk a little bit more about that last decision, because the 50 basis points, as I mentioned, was more aggressive than a lot of market watchers were expecting. Can you take us into the room a little bit? How intense was the discussion?
Sure. I think the market had us picking somewhere between 25 and 50, given that we've never sort of cut by 33 or 37 basis points. I think it would have been a surprise to the market whichever way we went. And I think that pricing was pretty accurate, actually. It wasn't a coin toss, but it was a very finely balanced decision whether we did the 25 or the 50. And it was all about the balance of risk. As I said, that negative 0.9, it sort of raises the possibility of a more prolonged period of excess capacity in the New Zealand economy. So, with meaning less medium-term inflation pressures. So we wanted to react to that. But on the other hand, we've got inflation at 3% or around 3% currently. That's our prediction for the Q3 number. So, we're looking through it. We know what's causing that, and we are confident that that is going to dissipate. But yeah, it's a little nerve-wracking being on a monetary policy committee with inflation right up the top of our band. The risk, of course, is that it gets ingrained in people's expectations and stays up there for longer.
So you mentioned you are looking through it. You're confident it's going to come down. How confident are you we're going to hit that 2% level by mid-2026? What would be the factors that drive inflation that low?
Well, I think having excess capacity in the economy is a big part of that. So, the relationship between the output gap, our measure of excess capacity in the New Zealand economy, and inflation is actually pretty solid. So the fact that we have had a period of excess capacity gives us confidence that those temporary factors that are keeping inflation elevated currently will dissipate, and our projections, we've got it getting down to around that 2% level in the first half of 2026.
When you were weighing that last decision, it coincided with the quarterly survey of business opinion, which was a bit worried about excess precaution by households and businesses.
Yeah.
Did that have much of an influence on your thinking, and will it going forward?
Yes, we liked that survey, the QSBO by NZIER. It gives us a good read on how businesses are feeling. We got that data on the Monday before the decision on the Wednesday, and I think it just it sort of solidified our thinking around the 50 basis points. So it was pretty sort of soggy from a business expectations perspective, there was also, I've got to say, plenty of pricing pressure in there as well. In fact, the gap between prices that businesses are paying for their productive inputs and what they're charging for their outputs is very wide at the moment. So again, that sort of, on the one hand, you've got slow growth. On the other hand, you do have pricing pressures in the New Zealand economy, and just juggling that, on balance, we came down in favour of the 50.
Now, you mentioned productive inputs there, and you told me earlier that you've been doing a lot of work around productivity. Sarah Hunter at the RBA mentioned this is definitely an issue in Australia as well. Tell us more about the productivity equation in New Zealand and what can be done to lift that.
Yeah, so I've personally been interested in productivity and done heaps of work on it over the last 20 years or so. Of course, we're interested in it at the Reserve Bank. It's a key input into the potential output of the New Zealand economy. I sort of think of it as half of our output gap. As you no doubt know, Paul, New Zealand has a pretty lamentable productivity growth record. The fundamental challenge in New Zealand is improving that. I talked earlier about a pickup in economic growth in New Zealand. We see that as a cyclical upturn in the economy as that output growth gap closes. The more fundamental, longer-run challenge is to improve the rate of potential output growth in New Zealand, which is something that monetary policy has very little sway over. It's more about regulatory settings, etc. And as Sarah was talking about, the adoption of new technologies by business, I think now is potentially a very interesting period for businesses where there are options to increase their productivity. And one of the reasons why productivity growth in New Zealand has been weak is that businesses have been kind of slow to make the most of new technologies.
In terms of stimulus, I mean, obviously that's going to help some productivity and growth as well. Are the stimulus settings right? Does the economy need more, not just on the fiscal side, but what can you do on the monetary side? We've got economists seeing more cuts in November. Are they right?
Yeah, well, on the fiscal side, the government's been very clear that it's all about consolidating government expenditures, and we're fine with that. Monetary policy moves second. We sort of take that as a given and respond accordingly. In the last record of meeting from last week, the committee said that we're open to further cuts in the official cash rate going forward, as required, to make sure that those medium-term inflation pressures settle around the midpoint of the target band. So, we're open to it, but let's see how the data plays out over the coming weeks and months.
We heard from the Finance Minister, Nicola Willis, at the Bloomberg address last week in Auckland. She was talking about and welcoming moves towards improved transparency around monetary policy decisions as well, wondering if the board and the governor wants to make those changes. What are your feelings on improved transparency and maybe attributed voting, divulging who said what during discussions?
So currently we are required to try and get to consensus around the normally 7 members of the committee. Currently there's 6. We're waiting for the new governor to come, and if we can't get to consensus, then we vote, and we've voted a few times over sort of at the turning point. We're more likely to vote at the turning point. In terms of moving to a regime where there's attributed votes, I'm very comfortable with it. I think I'd be fine with that. And again, it's up to the new governor when she takes up her post 1 December. We're looking forward to it.
All right, Paul Conway, thanks so much for your time today. Paul Conway is Chief Economist at the Reserve Bank of New Zealand. And we have more heads on the Asia trade. Stay with us. This is Bloomberg.
The tariff shock is here, and it is further dimming already weak growth prospects. This is clear even in the US. Growth is revised down from last year, the labor market is weakening, and inflation has been revised up and is persistently above target. Signs that the economy has been hit by a negative supply shock.
That's the IMF chief economist there on growing headwinds for the US and global economies as well. And in terms of risks, Bell, we've had a bit of commentary as well from the big US banks, which were out with earnings. I want to talk about JP Morgan. I mean, it was an earnings beat. They beat their own guidance as well. But it was comments from JP Morgan afterwards that made people a little bit concerned. He's been warning about the quality of credit, and certainly JP Morgan had a brush with this as well, taking $170 million hits on the auto dealer tricolor collapsing. Called that not our finest moment, but JP Morgan setting aside 810 million in its reserves for potentially soured loans. Jamie Dimon saying, well, you know, that old saying, there's never just one cockroach, is there?
You should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, you know, we think we're okay in other stuff, but my antenna goes up when things like that happen. And you know, I probably shouldn't say this, but when you see one cockroach, there are probably more. You know, and so everyone should be forewarned on this one.
Yeah, so Paul, you start to see those signals. Maybe cracks are falling or forming in the global system, in the global credit system as well. What does that mean then for the broader economy and also for what's been one of the major market drivers, which is AI? And are we going to start to see that investment pay off? Are we in a bubble? Well, we've just actually had a result out, or a Bank of America survey coming out, and it does show that there is a record share of global fund managers and also others that responded, but essentially saying AI stocks are in a bubble following a rally this year. So, I mean, it was only 54% of participants that said, yes, we're in a bubble. So it shows there's still clear division around this. And some are saying that, no, we won't see that. But as you were saying earlier with Garfield, is this going to be a bubble that bursts? Are we looking at one that just slowly deflates? Certainly, you have seen that huge outperformance of AI stocks over this year or even over the past 3 months. But it is a story as well that's also been very much playing into the China session, because we've seen that as one of the key drivers for the Hang Seng Tech Gauge. We are, though, now nearing perhaps correction territory. So certainly trade tensions, again, are continuing to play into that as well. So we will be watching how mainland markets, Hong Kong, open in the next hour. Big focus as well when we talk about tech, the AI bubble. How will TSMC's results look tomorrow when it reports? The expectation is it should be a pretty solid reading. But we do see the MSCI Asia Pacific gauge in the green. We'll get more details on that. This is Bloomberg.